Welcome to the Wealthfinity channel, where we share tips and strategies to help you build and maintain wealth for a financially secure future. In this video, we will be discussing demystifying India's inflation rates, insights and strategies, an important aspect of personal finance that can help you reach your financial goals. So sit back, relax, and join us as we explore the world of wealth building. Don't forget to hit the subscribe button and turn on notifications to never miss out on our valuable content. Let's get started. India is currently experiencing a period of high inflation, with rates reaching as high as 7.59% in December 2020. This can have a significant impact on the country's economy and the financial well-being of its citizens. In this video, we will discuss what inflation is, what causes it, and how individuals and businesses can adapt to the current inflationary environment in India. India's inflation rate has been a topic of concern for economists and policymakers in recent years. Inflation is a measure of the rate at which the general price level of goods and services in an economy is rising, and is typically measured by the Consumer Price Index, CPI, or the Wholesale Price Index, WPI. Inflation is the rate at which the general level of prices for goods and services is rising and subsequently, purchasing power is falling. In other words, it is a measure of how much more expensive it is to buy the same basket of goods and services over time. Inflation can be caused by a variety of factors, including an increase in the cost of production, a rise in demand for goods and services, or an increase in the money supply. In India, inflation has been driven by a combination of factors. One of the main drivers is the increase in food prices, which makes up a significant portion of the Consumer Price Index, CPI. This has been caused by supply chain disruptions caused by the COVID-19 pandemic, as well as heavy monsoon rains that have damaged crops. Additionally, fuel prices have also been a major contributor to inflation, as the price of crude oil has risen in recent months. The Reserve Bank of India, RBI, has set an inflation target of 4%, with a tolerance limit of plus or minus 2%. However, in recent years, India's inflation rate has been consistently higher than this target. In 2020, the inflation rate reached a high of 7.59% in November, before dropping to 4.59% in December. This trend has continued into 2021, with inflation reaching 5.03% in January. To adapt to the current inflationary environment, individuals and businesses need to take a long-term view and make adjustments to their financial strategies. One way to do this is by investing in assets that are less affected by inflation, such as real estate or stocks. Additionally, it's also important to focus on building an emergency fund and cutting unnecessary expenses. Another way to adapt to inflation is by managing your debt. It is important to prioritize paying off high-interest debt, such as credit card balances, as the interest rates on these debts will continue to rise with inflation. And also, it is a good idea to invest in bonds, as they tend to perform well in inflationary environments. One of the main drivers of inflation in India has been food prices. The country is heavily dependent on agriculture, and a variety of factors such as weather conditions, crop failures, and supply chain disruptions have contributed to the rise in food prices. Businesses can also adapt to inflation by focusing on cost-cutting measures, such as automating processes or outsourcing certain tasks. Additionally, companies can also focus on increasing productivity and efficiency to stay competitive in a challenging economic environment. The government and the RBI have taken several measures to curb inflation. The government has implemented price control measures for essential goods and services, and the RBI has increased interest rates to curb demand and cool down the economy. However, these measures have not been fully effective in bringing inflation under control. Another factor that has contributed to inflation in India is the depreciating value of the rupee. The rupee has been losing value against the US dollar in recent years, making imports more expensive and further pushing up prices. The government has implemented measures to support the rupee, such as increasing foreign exchange reserves and tightening capital controls. India's inflation rate has been a cause for concern in recent years. The main drivers of inflation have been food prices and the depreciating value of the rupee. The government and the RBI have taken several measures to curb inflation, but they have not been fully effective. The ongoing COVID-19 pandemic has also added to the inflationary pressures. It remains to be seen what the future holds for India's inflation rate, but it is clear that it will continue to be a closely watched economic indicator. In conclusion, India's inflation rates have been a topic of concern for policymakers and the general public alike. However, by understanding the underlying factors that contribute to inflation, such as food prices, fuel prices, and monetary policy, we can better anticipate and respond to changes in inflation. Additionally, implementing strategies such as increasing supply through agricultural and infrastructure development, as well as utilizing monetary policy tools such as interest rate adjustments, can help to mitigate the impact of inflation on the economy and the general public. Overall, it is important to continue monitoring and analyzing inflation trends in India in order to develop effective policies and strategies for managing inflation in the future.